Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, June 12th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another big trading day ahead. Already this morning, we have gotten the May CPI results, and they were good. We had the headline number come in flat, 0.0%. Market was only expecting a 0.1% rise, but when we go to the stripped out version, the core CPI taking out food and energy, we saw a rise of 0.2%, which was below the 0.3% expected, and also replaces a much higher number from prior year, May 2023 reading. So as a result, we saw the annual CPI rate drop down to 3.4%. Which is the lowest now that we've seen in the past few years, and takes us, getting closer and closer to the Fed's 2% target. But all is not done yet today because we have the Fed meeting coming up at 2 p.m. this afternoon. And while the bulls are rallying this morning with the news on the CPI report, we know what can happen at 2 o'clock in the afternoon. So I'm just going to be holding my breath once again going into that 2 o'clock announcement. Of course, this has been a two-day meeting. The Fed started their meeting yesterday, culminates today in this announcement at 2 p.m., where most of the market is expecting no change. I'm still holding out slight hope that they will cut, make a surprise announcement, but my guess is that probably will have to wait a little bit longer, maybe into the September meeting, something like that. But hey, I can dream. Anyhow, we'll see what happens, but that was good news on the inflation front for sure. Also, we had Oracle reporting after the bell yesterday. Oracle coming in better than expected. And let me give you the last quote there, and I'll give you the futures as well. Oracle last check was up 8% from yesterday's close, trading up $9.97 to 133.85. That was from yesterday's close at 123.88. And that is also clearing the high on Oracle from back in March, when it was up around 131, 132. So it looks like a nice clean breakout on Oracle at the open, assuming that we hold up at that level above 133 at the opening bell. Looking at futures for this morning, diamonds right now up 0.9%. That's up 344 to 391.41. If you recall, we closed just over the 400 level just a few weeks ago. Moving back in that direction, but still got a little bit room to go on the diamonds. The Spider SPY, which tracks the S&P 500, currently up 0.9%. It's up almost $5 to 541.77. That is deeper into record high territory. The QQQ also jumping this morning, almost up a full percentage point, up 445 to 472.47. That too is a record high. So we will be opening at record highs on both the S&P 500 and on the NASDAQ. The IWM, though, that has been lagging badly, actually up almost 3% this morning, up $5.76 to 206.40. Still got some room to go, another 2 or 3% for a breakout. But that was welcome news to me and to a lot of folks looking for small caps to benefit from the potential of lower rates ahead. And that's exactly what the CPI report gave us today. Coming in below expectations, it gives the Fed at least some ammo to be considering rate cuts. Whether or not they do it today, probably not today, but I would expect by September that we'll see a rate cut, especially if we see this CPI number continue to come in around 0.2%. Remember, 0.2% times 12 months is 2.4. That's really close to their target level. So if we start seeing more and more readings around 0.2%, that's when I would expect that we're going to see perhaps a rate cut, maybe the start of several. All right, let's see here. Let's check out what happened on Tuesday. Zero in here for you. So the Dow Jones Industrial finished down 121 points, That was down about 1/3 of 1%, back down below both the moving averages, but I suspect we will have, with this gap up, a move back up to around those moving averages, possibly even slightly above. The S&P 500 yesterday rallying 1/4 of 1%. That was another 14.5 points to set a new record closing high on the S&P 500 at 5375, right around the corner from 5400. And with today's move up of maybe 1% or so, we're probably going to see 5400 at the opening bell or above on the S&P 500. More welcome news for the bulls out there. NASDAQ 100 rising 136 points yesterday. That was 0.7 of 1%. Another potential 1% this morning. That would take us up perhaps, let's see, that would take us up about another right around 190 points, which would take us to about 19.4. We closed at an all-time high yesterday, so we're just tacking on to it again today. Notice the AD lines, though, that are now pointing straight up on these two key moving averages. Starting to see it move up on the mid caps, even though the mid caps have been in a decline. That will change today, at least at the opening bell, when we jump up on the MDY, or the mid cap ETF. Let me see what that's up this morning. That's up 1.71%. So looking at the mid cap index, 2913, so that would give us another roughly 50 points, which would take us back to 2963 at the open. That would be above both of the moving averages, both the 50 simple and the 20 EMA. And by the way, I get this question a lot. Why do I use the simple moving average for one? Why do I use the exponential moving average for the other? It's just something I've done over the years. To me, what makes sense is having an exponential moving average on a short-term moving average and using the simple moving average on a long-term. I don't really understand why we would look at a long-term and then want to factor in or provide more emphasis on the most recent data. That just, I don't know, something just doesn't make sense. I understand it on a short-term moving average where it's more momentum-based, and you want to look at the most recent data more closely. So I get the EMA for a 20-day moving average. I just don't get the EMA for a 50 or especially a 200. If you use simple for 50, it's probably not going to be that much of a difference. Sometimes the 200-day, the simple versus EMA, can be significantly different. Well, not significantly. It just depends on how you look at that. But it just doesn't make sense to me. I don't understand why you want to back off and look all the way back 200 days and then focus most of your look at the most recent data. Anyway, that's just me. It's just a little quirk about the way I look at the market, but that's why I use EMA and SMA. IWM rallied back yesterday again for the second straight day. In fact, I'll pull up this chart for a second. I want to show you the last 2 days prior to what happened this morning with the CPI. But we had gapped down back on Monday of this week, and then you could see buying throughout the rest of the day. Yesterday, we gapped down again, went down and tested that low. And then for the second straight day, we saw mostly buying throughout the day. So these last 2 days have been somewhat bullish, even though we're down from where we were at Friday's close. Because again, it's been mostly just gap downs and then buying all day long. Gap down, buying all day long, 2 days in a row. So it looks like accumulation to me. And then today we get the good news. Whether or not there's some kind of connection there, I'll leave that for you to decide. But it does always look suspicious to me when I see a lot of accumulation take place right before a good report and a big gap up in the market, because that's what we're seeing with the IWM today. A big move to the upside, gaining nearly 3%, and in pre-market being up around the 206 area on the IWM. Let's see, moving back to take a look here. Transports, let me see what the IYT is doing pre-market. IYT only up about a little more than 1/3 of 1%. So if we translate that into transportation points, that would be roughly about 50 points, which would take us up to 15,072. Still well below both the 20 and the 50 moving averages. So if there's one possible positive sign here, it's the fact that we do have the AD line turning back to the upside. So maybe this is the start of something on the transports, but we need to see some volume or some price follow through back to the upside. And we really haven't seen any of that just yet. The technology group broke out yesterday. I'm sure going to have another big day today. Let's see, XLK in the pre-market up 1.1% to 222.59. The question is, do we finish strong today after that Fed meeting at 2 p.m.? Or does the Fed spook the market again, basically saying, oh, maybe they're going to focus on the jobs report, which came in stronger than expected. I don't know. We'll see what the Fed has to say at 2 o'clock. My guess is after this CPI number that they would talk more dovishly, but I don't know. We'll see. The Fed surprised me many times in the past, this particular Fed. So I don't anticipate anything. I like to see what they have to say. Communication services yesterday, the only other group, the only other sector anyway, that was in positive territory. So 9 of the 11 sectors were down, and they were led by the financials, which were down more than 1.15%. That is odd because we have seen some strength recently in the, I was talking about that, I think, yesterday in the asset manager group. But today, looking at yesterday's action, it's all about the aggressive areas. Computer hardware. Apple yesterday talked a little bit about its AI plans. Market exploded, especially around Apple, and that took the computer hardware index way higher. The specialty retail group, I mentioned this one. I think I wrote about this in the daily market report just maybe a few days ago. But off of this move to the upside, I had annotated the recent highs around 3,000 and the lows around 2,900. Saying that this is like sideways consolidation, how this normally breaks to the upside. We had a good day yesterday. It was up over 1%, got back to 29.84. Do we get a breakout in the specialty retail group today? That would be and it would be short-term breakout. We still have the March high to deal with, but a lot of congestion over the last few weeks up near this 3,000 level. Be nice to take that out. Internet stocks also continuing to move to the upside, likely to see another big push here to the upside in terms of some of the pre-market action. Let's see, Meta up another 1.55%. That's up $7.86 to $515.33. Google up about 0.75% to $177.95. Netflix up about 0.2% to $652.79. Those are 3 key stocks in the internet space. So clearly, we're in a breakout mode, and it's likely to get better at today's open. So we're getting some good corroboration on this move to the upside in terms of many of these aggressive groups, still leaving the small caps, mid caps, and even the Dow to some extent behind. But they're all in uptrends. Even the IWM, if you look at the long-term chart, it remains in an uptrend. So there's nothing in the market, or very little in the market, that I would say is in a downtrend. One of the things that remains in a downtrend, believe it or not, on a relative basis anyway, is gold and silver. Gold and silver had that big run. They've kind of cooled their jets here recently, and relative to the S&P 500, which keeps going up to all-time highs, gold and silver have been performing really poorly for the last month or two. So we'll see whether or not that continues. But I've been saying for years, and I continue to say, gold and silver are not good investments relative to the S&P 500. You can talk about all-time highs. You can talk about the strength that they saw back in February, March into April. But I'm talking about on a relative basis. Does it make more sense to just buy the S&P 500? Or would you rather be in gold and silver? And I think if you look at the chart, the answer is very clear. These two groups, or these two commodities, gold and silver, have been downtrending versus the S&P 500 since 2011. 13 years now, they've been underperforming. I'm not getting excited by these short-term breakouts. What I have said about gold and silver is you can trade them, but you don't hold them because they have not been a good investment long-term. 10-year treasury yield. Let's move on, see where we're at here. We're down to the 4.30 level. We went just down to maybe even a little bit below the recent low with the CPI news out this morning. So right now we're down 10 basis points, down to 430 from yesterday's close at 440. and we are challenging the lows all of a sudden. What will the Fed have to say? What impact is that going to have on the bond market? We don't know. I can tell you that around 1:59 this afternoon, you might want to get your seatbelt out, buckle up, get your hard hat on, because at 2 o'clock, anything goes. We could be in a massive rally and the Fed might say something, and you might see all of the gains given up in 10, 15 minutes. I mean, that's just the way Fed day is, Fed announcement day. So just be prepared 2 o'clock this afternoon for whatever might come. And I don't know what's going to come. I would think, like I said earlier, that they'd be a little bit more dovish, seeing how we got another very low CPI reading, but market doesn't always work that way. We shall see later this afternoon. S&P 500, here's your uptrend. I've been saying, yes, negative divergence is present, but be careful, because we could just continue to go up. And then once you go up and the PPO no longer shows a negative divergence, most analysts will look back and say there never was one. Why? Because the PPO is going to eventually turn up. But if you break it down day by day, you can clearly see right now there is a textbook definition of a negative divergence in play. We scroll right in here, zoom in. Do we have higher prices? Yes. Do we have a lower momentum reading, in this case, the PPO? Yes. That's the definition of a negative divergence. We had it on the breakout, and we've had it on the 4 days since. Higher prices, lower PPO. But notice that PPO is rising. With today's action, let's say the Fed is dovish at 2 p.m. and we have not only an early morning explosion to the upside, but maybe we finish strong. We could see a big jump in that PPO. And then over the next few days, if we just kind of hold on to where, wherever today takes us, that PPO could be right back up above where we saw it just a few weeks ago. So be careful about these negative divergences, because they do disappear. They do get eliminated. And you also want to pay attention to the volume. I'm going to talk about this just in a few minutes, a little bit later. So let me hold off on that. NASDAQ 100, beautiful finish yesterday, closing near the high. You can see this PPO actually almost already eliminated with today's gap up. If we hold it, my guess is that negative divergence on the NASDAQ will be gone, which underscores why you don't follow a secondary signal when it first appears, like this. Price volume is not going along with this secondary signal. We're still in bullish mode. We're still in all-time high territory, setting new highs every day. How can we call price volume action bearish when we just keep going up, setting new highs? I can't. And that is our absolute primary indicator, and nothing else is close. So you need a lot of secondary indicators coming together to offset this one primary indicator, which says stay long. IWM, this is one of the areas that has struggled on a relative basis, not keeping up with the S&P, not keeping up with the QQQ for sure. But we're going to get a nice pop today at the open, back up near the 205, 206 area. Let me give you the latest there on that. 206.33, up 2.84%. So we're all the way back up near 207. Or excuse me, not quite up to 207, 206.33. But not too far from the recent high that we set just about a week and a half ago. And within shouting distance of that high up around the 210, 211 area that we need to negotiate. So IWM, if the Fed is a little bit dovish this afternoon, this could turn out to be a huge day on the IWM. We'll see. Transports also trying to turn higher, but clearly the short term has been lower. We have lower lows, lower highs. There's a pattern here. First step, anytime that you are trending lower, the absolute first step is to get back up above the 20-day moving average. You have nothing if you are trading below the 20-day moving average. Probably the best you can have is a positive divergence developing. But I don't even see that here, because we just had a PPO reset. You zero in here and look at this. PPO is right at the zero line. We had moved up to the 50-day moving average, and we also hit the zero line. If you understand what the PPO is and you just don't follow lines on the chart, which is what I try to teach, you need to understand these indicators. When you get a center line test, the PPO is telling you that the 12 period and the 26 period moving averages are equal. There is no momentum in the market. Short term versus long term is exactly the same. So how can you claim positive divergence when you go back down again? You've already righted the ship from this negative PPO back here. You've gone back up. You've gotten back to the square one. We're even. Moving averages are exactly the same. That's what the zero line is. All this black line does is it tracks the distance between whatever two moving averages you use. The default is the 12 period and the 26 period, which is what I use. If you're trying to predict what folks in the market are going to do, technically, you need to use indicators that are generally used by the trading public. Those technical analysis traders, most are going to use defaults. I mean, you can use some crazy MACD or PPO, settings if you want, but if you're the only one using them, how can you use that to predict what other people are going to do, what other traders might do? So anyway, anytime I see that PPO reset, to me, I don't even care what happened before that zero test. All of this action back in the prior month or two, I don't care about it. Means nothing to me in terms of once I get a zero test, the only thing that matters is what happens going forward. And what happens going forward is we went down, price action went down, we failed at the 20-day EMA, and we're rolling over. We're staying below the 20-day. With this kind of a configuration on the PPO, that's bearish, short-term bearish. Cannot get away from it. On a price basis, we are short-term bearish. But that's really the only major index that I would say is short-term bearish. Just about everything else is either neutral or screaming bullish to the upside, as is the case with both the S&P 500 and the NASDAQ. All right, let's take a look at the chart of the day. I always talk about the chart of the day. It's the EB Digest. That's our 3 times a week newsletter. If you go over to earningsbeats.com, scroll down, you can sign up right here. Name and an email address. We'd love to have you. We got a lot of folks on this EB Digest newsletter, and it's also a group that we reach out to whenever we do free events. We'll probably have some of those coming up, so you want to make sure that you are part of our community so that when we do have these free events, we can reach out to you and give you room instructions. And you can either join us or you can watch the recording at your leisure. We send out a recording to our list as well. If you want to sign up for our service, up here at the top, you can hit that green button, start your no-cost trial. You get 30 days for free. So you can check us out for 30 days. We have our live trading room coming up later this morning. That will start at 10 a.m. If you don't have to be a paid member. You can be a trial member. But if you sign up, you'll have the trading room for the next 5 Wednesdays, 5 times, where we'll be going through and I'll be showing you how I approach the market. Sometimes I'll take positions, sometimes I won't. Today we're getting a big gap up. I don't know how many positions I will take, if any, but I can tell you there are going to be a lot of charts that are going to look a lot better today than they did yesterday or last week based on what we're seeing in the pre-market. So anyway, make sure you sign up for that no-cost 30-day trial. Come join me later this morning in about 37 minutes. We'll be opening the trading room. We'll send out room instructions, make sure everybody has those, and you can join us, like I said, in 37 minutes. So what's the chart of the day today? Well, I want to just talk about, this is Apple, and I want to go over the negative divergence. I want to go over the textbook definition. This is what I was talking about earlier. And just point out sometimes how silly it is to think negative divergence when a stock is trending higher. Look at Apple yesterday. Now, Apple absolutely exploded. And I went back over the last 3 years, and I think there were maybe 4 trading days in the last 3 years where we've seen bigger volume on Apple than we saw yesterday. 171 million shares. And I would offer up a guess that the dollar volume was the highest in the last 3 years. Keep in mind, the volume is normally going to be higher if the price of the stock is lower, right? I mean, if the same number of shares are bought at a lower price than the higher price, then the higher price obviously has got more dollar volume. And yesterday we broke out to an all-time high, and a lot of this volume was coming in at these higher prices. So yeah, there have been 4 days that have had higher volume, but the price was lower then. So if we had a dollar volume calculation, my guess is that Apple would have posted its highest dollar volume day in the last 3 years. So with this huge bullish candle, I mean, let's zero in and look at this thing. This is a Maribozu candle. This is the most bullish candle you can see. When you open at your low and you close on your high, and the candle is this long, that hollow candle, on this kind of volume, can you really, with a straight face, try to tell me that momentum is slowing because the PPO is lower right now? Do you really seriously look at this chart and see slowing momentum? This is why following the textbook definition isn't always the correct answer. Yes, this is a negative divergence. No, there is not slowing momentum. Apple went up $14 yesterday after gapping down $3 at the open. I mean, from low to high, low was 193, closed at 207. So we were up $14. I'm sitting here looking at this thinking this moved lower on the gap. It gapped slightly higher and then moved up $14, closing at 207.15. The high was 207.16. The open was 193.65 and the low was 193.63. So from open to close, we had 2 cents below the open, it's as far as it ever went, and 1 penny above the close. That is one of the strongest Maribozu candles I have ever seen. And we're going to talk about slowing momentum? Really? That is not slowing momentum, folks. And this is why you can't just look at lines. You can't look at this and say negative divergence, I'm going to short. I mean, maybe Apple goes down, but I see massive accumulation here. And if it does go down in the short term, to me, it's an opportunity to buy because I see Apple. I talked about Apple back in the 160s being accumulated and being manipulated with gaps down, morning weakness, and then afternoon buying. We talked about that a few months ago. And I said, we're going back to all-time highs. Here we are. Now we're going to talk about a slowing momentum. To each his or her own. That's all I can say. I see no slowing momentum there. There's something else I wanted to talk about. Oh, actually, what I wanted to do is I wanted to go in. I'm going to look at your comments today and see if you have any questions. I'll try and take a look real quick. Let's see. Lots of morning election year up. Yep, you got to be careful over the summer, though. I'm not sure we're completely out of the woods. Normally, July, more so August and September, like the second half of August and into September, we tend to see some weakness, not only in presidential election years, but just in all years in general. That's people say go away in May. It's not go away in May. It's go away July 17th. I'll even pinpoint it to the day for you. Historically, doesn't mean this year that on July 17th, the market collapses. It just means historically, the tendency is for the stock market to struggle, if it's going to, between July 17th and I think it's September 26th. That's the time period that you need to be careful ordinarily in any year, but maybe even a little bit stronger in a presidential election year. Actually, I've seen this before. I appreciate that comment, Rick. And Tyler, we need to take note of this. Apparently, when I'm going over the chart, if a chart's going up from left to right, the most important thing's up the upper right-hand part of the screen, and that's where my picture shows up. So maybe, I don't know if we can control this, but maybe we need to move that picture over to the other side of the screen, or even at the bottom would be better than at the top right, because it does block out. I'm looking at it right now. It's kind of blocking out that negative divergence a little bit right now. So point well taken, and we'll see if we can come up with something there. Oh, and then of course the next comment. There we go. It looks like Tyler already has seen it. What about seeing a huge candle near highs? Earnings were not that great. I'm not sure. Are we talking about Apple? I'm not sure which one we're talking about, and I don't recall Apple's earnings. But I think what the market is doing, what the market generally does, is it's looking forward. So for me, it's about whether or not management, misses or not. If management, if we come in with revenues and earnings that beat management expectations, to me, that's generally a pretty good sign. That management's being a little cautious, which is what I like to see, which is what we've seen out of Apple for many, many, many years. They tend to guide a little bit low and then come through and beat. And that's what I like to see. I like to see management teams, when they put estimates out there, I like for those estimates to be lowballed so that when numbers come in, they tend to be higher, which means results perhaps in some higher valuations. But I mean, I don't argue with a candle like this. I don't care if the earnings were bad last quarter or not. When I see a candle that's going up the way Apple's went up yesterday, there's a lot of folks jumping in, expecting some big things from Apple. And we know how big that AI space is. And we know what's happened with NVIDIA already and SMCI. I know SMCI has been struggling, but that's after it went up from 100 to 1,200 or whatever it did, 200 to 1,200. So it's kind of come back down and consolidated. But, many of these AI stocks have made big moves. And if Apple has a plan to benefit from that with their, power and the size of the company, we should take note. And I think that's exactly what happened yesterday. I think a lot of people took note and were buying hand over fist. So I see the chart on Apple as being extremely, extremely bullish. After a move like that, might we go back down below 200 again? We might. I don't know. I would use that as a buying opportunity, but otherwise, I see nothing but higher prices ahead for Apple. What do you think about CLS? Well, what do I think about? Wait, let me back up one more. Any hope for big banks? I think there's plenty of hope for big banks. The problem is, if you look at banks throughout this bear market, during this entire secular bull market, banks don't lead. Banks go along for the ride. So I think that we are seeing leadership, and I thought banks would do well this year because I thought it would be a period where their earnings would go up quite a bit with rates coming back down. Rates haven't come back down, but the big banks still have a lot of other areas that have performed well, like their trading operations and so forth. The smaller and mid-sized banks are the ones that have really struggled because they rely more on traditional banking operations. And with rates high and an inverted yield curve, it's hard for them to make money and certainly hard for them to grow their earnings. So I think the small banks, that's what I've been saying all along. I mean, the banks are one of the largest areas of small caps, those small and mid-size banks. Hold on one second. So those small banks are really looking for the Fed to start cutting rates. I think that is what's going to spur the small cap banks. And the KRE, which is the ETF that tracks small and mid-sized, regional banks, that has done well at times this year, but every time it's disappointed by the Fed continuing to push out the rate cuts. I don't know what they're going to say this afternoon, but if they say something that suggests that maybe they're feeling better about cutting rates, maybe in September, or it would be great if they did something today. I just don't think they're going to do that. But if they come up with some kind of a surprisingly dovish comments, I think would be something that would probably send the KRE higher today and into the short term in the future. I think once we start realizing that the Fed is going to cut and that they are going to start this rate cutting campaign, I think the small cap banks are going to do extremely well. I think large cap will do fine too, but I think that's when we're going to start to see the IWM do a lot better than the QQQ. Could I be wrong? Sure, I've been wrong for the last 6 months or longer on the IWM. It continues to, frustrate me in terms of the performance, but kind of like back in 2022 when I thought market bottomed in June, we ended up bottoming in, December, or actually in October, and then we really started moving at the end of December into the early part of January 2022. So I don't feel like I was wrong. I just feel like we didn't get that follow through from all the manipulation until 6 months later. I'm not sure this is going to be any different. I think that as we get more and more information and more and more, we start seeing more and more leaning toward rate cuts and then the actual cuts themselves, that's when I would expect the IWM and in particular small cap banks, mid-sized banks, to do extremely well and to outperform. Now, if we start getting cuts and the market and the Fed gets much more dovish, and we're still seeing the same IWM action sideways while the QQQ keeps going higher along with the S&P 500, then I would admit at that point that I've made a bad call. But I want to see this play out. My reasoning for banks and for the IWM to outperform is the lower rates coming down the road. We really haven't seen that. The Fed's been all over the place. I think once we have a more concerted effort toward lowering rates and moving in that direction, that's when I would expect the IWM to outperform. The market does anticipate as well. So I would look for it even maybe before we start to see that. And that's the part that's been frustrating for me, because we see it for a couple of weeks or a month and then we lose it again. And then we see it again for a couple of weeks. We start seeing a little manipulation and then we lose it again. But we'll see what happens in the second half of the year. Maybe it's a delay similar to what we saw with the QQQ and the spider back in 2022. Apple or another, CLS. Keep skipping CLS. What do I think about CLS? Well, I think CLS is fine. We are well after 9:30, so I'm going to have to get going. CLS jumping today, $1.21, back to 54. I mean, we're in an uptrend. We pulled back literally right to where we had gapped up from. Right here, when we gapped up, we took out that prior high. I don't see anything wrong with CLS. It's been volatile over the last week. If I had done what I wanted to do or what I talked about doing last Wednesday, I'd have been very happy, because I said at the beginning when we bought CLS, or when I bought CLS at the last Wednesday's in the last Wednesday's trading room, I even made the comment that if CLS goes up 5 or 6% in a day, I would maybe think about taking that kind of a gain, just because why wouldn't you take 5 or 6% in one day? Well, I didn't. And I ended up getting stopped out the next day. I still made money, but it wasn't nearly as much. I think I walked away with maybe 2% instead of 5.5% or whatever it was. So there's nothing wrong with trading if you get a big gain to take it during the day. Maybe some of the folks in the trading room did. I don't know. But it made a huge move. That was on this day right back in here. Let me zero in. See this hollow candle right here? And again, maybe my picture's covering it. I apologize. Maybe scrolling down will help you here. Anyhow, maybe right here, this hollow candle looked good. Next day it went right back down. Then we printed a hammer. Now here back up we go again. I mean, the stock market's volatile. I wish when I got into a stock it went up every single day after I did that, but it's not the way the market works. And so it just depends on how much risk you want to take to the downside versus how much upside you think there is. I think CLS is a good swing trade candidate, meaning that you can hold it for a little while. But if you're going to hold it for a little bit longer because you're looking for more returns to the upside, that's when you should give yourself more room to the downside. Otherwise, if you mix and match strategies, if you say, well, I'm going to hold this for the long term, but I'm going to keep a tight stop today, you're day trading it on the downside, but you're swing trading it to the upside. Not really a good idea. I think a better move when you're swing trading is to either get in, give a little bit more room to the downside, or to buy in a couple of different instances. And I think I talked about that last week as well. It was trading like at 53.50 or 53.60, I think, when I bought it last week. And I even mentioned that, hey, you got gap support down closer to 50.51. So you could buy half. And if it goes down there, you buy the second half. And then maybe use gap support, 50-day moving average, something like that as your closing stop. Give it some room if you're swing trading it. Anyway, CLS starting to turn back up. I think it goes higher. That's my personal opinion. Small caps are having, Apple or another exhaust. See, this is not an exhaustion gap to me on Apple. This is not an exhaustion type of a trade on Apple. An exhaustion gap to me would be a gap up and then usually some kind of a reversing candle, or a gap up and move up intraday and leave a long tail and come back down and finish near the open, like a doji or a shooting star. Or you gap up and you sell off all day, bearish engulfing. The volume should be the highest you see on the chart. That's about the only similar characteristic I see with Apple. Apple's been going sideways, actually, if you look at a chart. Look at this. This thing hasn't been going straight up. It's only been going up for the last month. And it's just breaking out above some serious long-term consolidation. That's not when an exhaustion gap forms. An exhaustion gap forms when you're something like NVIDIA, where you just keep going up and up from 100 to 1200 over the course of 2 years. At some point, we might see a massive gap to the upside. NVIDIA comes out with just crazy good news, and the final folks jump in and chase it up 10 or 15% one morning. And then a lot of the institutions decide, okay, this is starting to get a little pricey. We're going to start unloading into this strength. And so by the end of the day, you get this big reversing candle after a 2-year uptrend. That would be more of what you look for with an exhaustion candle. Anyway, I'm going to move real quick. Small caps get party time. I don't know what's going on here. That's pretty much where it opened. I know it gets boring, but Tesla, not a great chart. Well, Tesla, NVIDIA wasn't a good chart 2 years ago. These stocks, short term, I think Tesla was showing signs. I was talking about the manipulation that had been taking place in Tesla. I don't know if it was quite as great as what we saw in Apple, but it was still, there's been definitely some signs of accumulation with Tesla. And I want to update this one for May and see what it looks like. I haven't done that yet. But right now in the short term for Tesla, watch this gap support. We had a big move up on the heaviest volume of the year that came in from about 168 or 169. And notice the lows came down right here, pretty much filling the gap. Yesterday, we came down, maybe even went just slightly below that prior low. Today might be a big move back to the upside. I agree with you. Tesla's been an underperformer. Tesla, by looking at the chart, clearly is downtrending. So am I as bullish about Tesla right now as I am Apple? No. We need to see that price action. We need to see confirmation back to the upside. But I am bullish Tesla going out longer term. If you look at the long-term 15-year monthly chart, it looks a little different than the daily chart. We went up crazy from, what is this, $12.50 to $425 in less than 3 years, or about 3 years. Actually less than 3 years. So, we're consolidating. I think the market cap is starting to catch up with, or sales and revenues and profits are starting to catch up to the market cap. Market cap's come down. The growth has still been there for Tesla in terms of profits over the years, moving higher. And so I think the stock is more fairly valued. Some would argue it's still way overvalued. I'm not in that camp. I think it's more fairly valued. But if we see some good news out of Tesla over the course of the next 3 or 6 months, and folks start getting a little bit more bullish, the stock will be back up over 400, in my opinion. And I don't think it might not be that far out. But again, I could be wrong. When, if ever, should we consider bonds? Well, I think bonds are great as part of a balanced portfolio. So obviously, as you get older, if you're in retirement, it's nice to have a good chunk of bonds, just because you know what your return is going to be if you hold it to maturity. It's going to be whatever that dividend yield was at the time you bought it. So that is more of a fixed income. I think it is much more appropriate for folks who are less aggressive, that are in retirement or nearing retirement, that just want to start parking more money, maybe start laddering those bonds so that every year something comes due and you're always, either if rates are dropping, unfortunately, you're getting some lower rates. But if rates are up, then you continue to get, to build your yields a little bit higher. I think the laddering structure on bonds is good. But what we do at Earnings Beats isn't really deciding between bonds and stocks. We're pretty much all stocks. That's what I talk about. I look at the bonds and I look at the yields primarily to help me call what's going on in the stock market, not to buy the bond or to sell the bond. I think there are probably others that are better than me and Earnings Beats as a whole if you're looking for when to buy and sell bonds. I would expect that the prices of bonds are going to go up and the yields are going to go down over the next couple of years, especially as inflation fears completely subside and we get the Fed funds rate dropping and the inflation expectations dropping. I would expect that folks will go back into bonds, which would send the yields lower. So I suspect now is a pretty good time to jump into bonds, but I think stock market's going to do better than bonds. So anyway, that's the way I look at it. AVGO earnings today. Let's see, AVGO Gap. They didn't report yet. They report after the bell, right? I think it's an after the bell report. I didn't see anything this morning on AVGO. Yeah, it just says reports earnings today at stock charts. Let me see, what's the volume? 522,000. Average volume is 2.4 million. I wouldn't think that that's volume. I don't think they've reported. Yeah, after the bell, someone said, okay, cool. That's what I thought. BRK, Berkshire's been trapped in a trading range recently. They own a huge position in Apple, maybe an opportunity. Absolutely. I mean, I don't know what the percentage is in Apple, but I know that Berkshire does have a large stake in Apple, and for good reason, as it continues to break out. Anyhow, we're way past. It's 9:46. I got to get ready for the trading room, which starts now in 13 minutes. But let's just take a quick look at what the market's doing. Dow up 300, S&P up 1%, NASDAQ 1.5%, small caps up almost 3%. Really good action. Look at the VIX dropping 53.53 down to 1232. I mean, if the Fed talks dovishly, we could really see a melt up this afternoon. And I see it across the board. Don't be surprised if the small caps, I mean, I know that's a big jump already, but we might see a 5% move in the IWM if the Fed cooperates. We'll see. This is a big day. Two big things here with the CPI in the morning and then the Fed announcement 2 o'clock this afternoon. Stay on your toes out there. I'll be back tomorrow with your next Trading Places Live. And of course, now in just about 12 minutes, we'll do our live trading room. So be sure, go in, start your no-cost trial, and come join me at 10 o'clock. Have a great day, everybody. And be sure to like the video and subscribe to our channel. That'll help us build our YouTube community. Appreciate all that you all do for us, all your support. Have a great day. Happy trading.